Hi. So in this video we're going to be discussing the results of a simulation that gives us the fair value of the S&P 500, and this is done in July of 2024. So we have two scenarios here, one on the left, one on the right. They are the same except for the earnings growth expectation. This is a more optimistic earnings growth expectation, and this is a less optimistic earnings growth expectation, and these two are from different analysts, so they provide a range of earnings growth expectations for the next year. So what we have here on this cell is a recent top of the S&P 500. This is the current values, gone down a little bit. Earnings for the previous year, earnings growth going forward for the next year, predicted earnings, the actual PE values, the 10-year interest rates that we currently have. Here's the fair PE given the interest rates, and then the fair price of the S&P 500. So as you can see, the more positive estimate is close to 2,900, and closer to 2,800 in the lowest estimate. So the drop, if this were to become reality, the drop would be close to 50% from a recent top, from the current value 47%. Now, someone looking at this may say, but this makes no sense, because when we look at here the Shiller PE ratio, which is inflation adjusted, we can see that PE values of that magnitude, around 10 or 12, they haven't been seen in a very long time in the S&P 500. So in fact, the trend has been for them to go up over time, right? So they keep on going up. So there is a trend for PE ratios to go up. So we have an issue here of valuations, right? So the PE ratio seems to be going up. Now, the reason for this, one could argue, is that the trend has been on 10-year Treasury rates, which are the ones that influence many prices and interest charge for various types of credit. These 10-year interest rates have been going down over time because the Fed funds rate, which is the very short-term rate, has been going down as well. Now it's going up recently, and that is the problem. That's why the results of this simulation suggest that this valuation, the current valuation of the S&P 500, is way higher than it should be, close to double what it should be. It's because of the 10-year interest rate. If this 10-year interest rate, even with, let me use this one on the side. So even with the lower expectation of earnings growth, and by the way, these expectations of earnings growth are quite remarkable, and the data suggests that we will have this increase in earnings growth. But on the other hand, past data suggests that interest rates of this magnitude would prevent earnings growth to continue. So what could be happening here is that you have an interplay between what's happening now, and inflation. So earnings growth tends to reflect inflation. So if inflation is high or is expected to be high, earnings are expected to be high as well because they are nominal. Earnings are nominal. So, but let's say I were to bring down this 10-year rate to 2%, then we would have a fair price for the S&P 500 of 6,000, so it's actually undervalued. Now you may say, well, the Fed is going to reduce interest rates, cut interest rates soon, and so this will become a fair value. Well, that's not what's going to happen. It's not going to go down to 2% right away. It's expected to go down in increments. So let's say it goes down to 4%. The market will still be overvalued. The S&P 500 would still be overvalued by quite a lot. And this assumes that the 10-year rate will follow the Fed funds rate, because it may not follow. And there are a number of reasons for that to happen. One of them is that buyers of treasuries may not be so interested in buying the 10-year. So the interest rate for the 10-year may go up even when the Fed funds rate goes down. That would cause an uninversion in the yield curve, and potentially we could see a recession coming. But what's happening here is that these numbers suggest that we are in a situation where markets are overvalued. The economy seems to be chugging along and surprising many people in terms of its growth, employment growth, as well as growth, GDP growth, earnings growth. Inflation has been going down, but still we have a 10-year rate that is just too high to justify these multiples. So something has to give at some point. One would think. So that's pretty much what this simulation suggests. Thank you for watching.